Hey everybody, Matt Graham, NBS Live here with you on Tuesday, March 24th, 2020. NBS had a great day today, up over a point even at the close, and despite some afternoon volatility, Treasuries a bit weaker. If we take a look at longer term charts, I like a 3-month chart right now, or a 1 month, but I think 3-month with a candlestick tells a little bit of a better story, and change the chart options to show the candlesticks there, and change one of them to 2.5 UMBS and one of them to 10-year yields. And this really tells the story about what's going on in the bond market. The least risky and most liquid bonds around being U.S. Treasuries, and they have had, relative to past precedent, an extremely volatile couple of weeks, but nothing nearly as volatile as MBS. But both are starting to sort of calm down, and you're seeing the relative level of surprise and enthusiasm, and now extra liquidity in MBS reflected in the charts here. So whereas Treasury yields are getting into a little bit of a narrow range finally, especially over the past 2 days. I mean, gosh, look how different these two candlesticks are from last week's. They are nonetheless trending very modestly higher in yield. MBS, however, are arguably trending higher in price. So MBS improving, whereas Treasuries are deteriorating. And that's a reflection of the improved liquidity and the Fed's ability to better inject liquidity into the MBS market, because it's much easier for them to instantly do all of the heavy lifting that's needed in the MBS market. And if you are not well availed of all the stuff that's going on behind the scenes, or in front of the scenes for that matter, I pinned 2 links in the news stream here, and I would recommend you click on them unless you're totally up to speed on everything that's going on, or if you just need to revisit it. This definitive Fed NBS Buying FAQ, and it has every link you're ever going to need to understand pretty much everything that's happened in the past few weeks, and then some, really. So read that. Let me know if you have any questions. You can use the Contact Us link in the Help menu, and I read all those emails and will get back to you as quickly as I can. Of course, the Fed is also buying Treasuries, and that's helping keep a lid on yields, helped to reinforce the ceiling here in the mid 1.2 range. And now it's just a matter of range finding for financial markets in general. You may have heard quite a bit about a massive rally in stocks today. I'll show you what that looks like on the chart from Refinitiv Icon, with the blue line being S&P futures and the yellow line being 10-year Treasury yields, minute by minute ticks here. And this little guy down here, this upward movement in this blue line, that's today's stock rally. As you can see, it leaves us in a position that it maybe isn't as thrilling as some of today's financial news headlines might suggest. But hey, look, it's a start. If you're hoping for stocks to improve, and I think most people are, it's a start. If you're hoping for stocks not to improve because that's how much you care about low rates, well, first of all, I think most originators have done battle with that inner voice that sort of is at odds between wanting economic chaos and ruin and as a trade-off for low rates. But it doesn't necessarily have to be mutually exclusive in the future we're heading into, simply because of the amount of support that we're going to have from the Fed on a somewhat ongoing basis. We're also going to have a sluggish economy, at the very least, even after we defeat whatever is coming our way in terms of recession or depression. There's a lot of unknowns left to sort through with coronavirus, and a wide range of possible outcomes with respect to how long it lasts, the loss of life, the strain on the medical system, and the strain, of course, on the economy. There's no way to know exactly what that's going to look like right now, and there's even no way to know if we can compare perfectly to other countries' scenarios, because we're not other countries, and things are going to play out a bit differently here for one of any number of reasons. So there's a lot of guesswork involved, and the best bet is to keep an eye on what's important and to remain nimble in how we react to it. So what's important right now is that 10-year yields are hanging out in this sub 1% range. And even if that is just a sub 1.3% range, that's still significant in the bigger picture. And it reflects, a lot of faith that the economy will be sluggish enough to justify yields that low, despite a massive amount of new Treasury issuance coming our way from stimulus measures. Issuance, again, is bad because, well, it's not bad, but it's bad for yields staying low because it creates bond market supply. Supply creates lower prices create higher yields. So if we're under 1.3, it gives us a solid platform as a mortgage-backed security to tighten, to perform well, to be happy, to create low mortgage rates. Anything 1.3 to 0.5 in that range. And then the tighter that range can be, the better the MBS market can perform. MBS likes stability, and they like treasury yields to not be rising too quickly or falling too quickly or moving back and forth too quickly. I guess that's another way to say stability, right? But stability in the range that is conducive to low rates would look something like, 1.3 on the high end, and let's call it 0.3 to 0.5 on the low end. The low end matters much less. The high end at 1.3 is the thing that allows us to really explore all-time low interest rates over time. Speaking of over time, all-time low interest rates are going to have to happen over time because it's going to take some time for volatility to shake out with respect to lenders' rate sheets. Mortgage market is more or less in total chaos right now, where the only guaranteed bid is for the TBA MBS, the stuff that we watch on our screens. There are a lot of other corners of the mortgage market that are taking heavy damage at the moment, and that can affect lenders that offer both conforming 30-year fixed rates and other types of loans. And really, anytime there's chaos in any corner of the mortgage market, it can sort of reverberate and cause volatility and inconsistency in rate sheets, inconsistency between lenders, and massive changes in rate sheets from reprice to reprice, which is something you're probably seeing. That stuff will progressively settle out, but between now and then, don't be surprised to see lenders playing hokey pokey with rate sheet availability. In other words, they're going to put their right foot in and drop rates a bunch and then pick up a bunch of locks, and then they're going to take their right foot out and raise rates so much that they are effectively saying no more locks for right now. So just understand that that's going to be the case and have that game plan in place with your borrowers. So when you see lenders put their right foot in, you're ready to capitalize on the lock if that's the rate that you all have agreed is enticing. Let me know what questions you guys have. We have really talked a lot, or I have talked a lot in these videos over the past few days, and they've been running over 20 minutes. This one's going to run under 10. First time in a while. So I'm going to cut it short for there and just say brass tacks on locking and floating is if you like it and your client likes it and it's pretty close to the recent lows that you've seen, there's no harm in taking it off the table. It continues to be a decent enough possibility that we're going to see slightly lower rates. It's not the kind of thing you can take for granted in this marketplace. A lot of unexpected things can happen to get in the way of that, not the least of which being business disruptions due to COVID-19 and various levels of shutdowns or lockdowns or shelters in place. But if your clients want to have their shelters in place or the financing for those shelters, you may need to jump on a rate and get things done before things get too crazy. Hopefully they get less crazy. You don't have to worry about it. So there's a case to lock. A case to float is somebody who doesn't necessarily need to refi right now, who's just waiting for that lowest possible rate. I think you have to draw a line in the sand and set a goal. You might not hit that all-time low, but if you come close enough to it and it's available and you know that you can get it closed in a decent amount of time, and especially before your lock window runs out, there's a solid amount of wisdom behind taking that risk off the table as well. But you're not insane to play that game if you feel like you know where this economy is going. Can be fun to find out. You might be right, you might be wrong, and you'll definitely learn something either way. That's going to do it for today. Back with you guys tomorrow. Have a great rest of your day.